are best to position inside this bull market? Let's ask Gabriela Santos, Chief Market Strategist for JPMorgan Asset Management, with us here again at Post 9. Nice to see you. Welcome back.
Nice to see you.
So what are we supposed to do in this market? So we're done with the rate cut, this one.
Yeah.
We're thinking about the elections, like 40 days away. It's nothing. And now we have China, which is stimulating their economy. What does it all mean?
So I think the combination of a proactive Fed, a continued expansion in the U.S., plus some stimulus out of China putting a bottom on Chinese growth is an environment where the global expansion continues and risk assets can continue to do well. So equities and credit. I think the question for investors is, all right, we're normalizing in economic terms and interest rates, but are my portfolios normalized for that environment? And we find that a lot of it tends to be offside.
What does that mean?
Especially if you think about the fixed income side. Cash rates, of course, were at 5.4%. And we found that investors have a lot of excess liquidity. And they've failed to build a core fixed income allocation. So the average portfolio we look at is about 37% allocation of core fixed income. 37 versus what we think would be normal, 65 to 75%. And that's what's coming down. It's cash rates. Post-Fed cut, they're down 26 basis points for the 1 month to 3 month. So that's the area where there's reinvestment risk, and we've already started to see some money to build out just more of a core fixed income allocation.
So you think that the money that's going to come out of cash, money markets and things like that, should find its way into credit more so than equities?
I think so. I think a lot of investors have been a bit barbelled. Either it's cash or it's equities, high yield, private credit. I think where it's most offsides is more the core fixed income. And there we're talking about investment grade bonds or securitized debt or slightly longer duration paper. That's there for kind of a lock in the income now and get yourself some just in case protection. Within the equity side, there we think there's more space still to rotate within it. Still find portfolios very concentrated by design or not on growth, on the U.S., and there's plenty of opportunity to kind of readjust.
So we should be believers in the broadening story as a result of this, looser policy from central banks and the economy holding up?
I think so. It gives us more conviction in the continued soft landing. Once we see and have seen central banks be proactive about normalizing interest rates and focusing on the downside to economic growth. And I think the data this morning also gives us more conviction, especially the revision to GDP and GDI, which kept actual consumption pretty strong at 2.8%, but revised up income and hence up the consumer savings rate by 1.9 percentage points. So there's still a little bit more gas than expected in the tank there for the consumer to keep going, and hence for non-tech related companies to improve.
What's on the line tomorrow morning with PCE, do you think?
So I think the market, rightfully so, is focusing less on the inflation side unless something reaccelerates, which is not expected. So really what we're focusing on tomorrow is much more the actual consumer spending data, which was near 3%, as we mentioned, in the second quarter, and is actually tracking around 3.5% again this quarter. So as gloomy as people feel, they still are spending at an aggregate level, and this really keeps this pro-risk, broadening out theme intact.